When you're a teacher and you spend 80 minutes, 26 sessions, 15 weeks, you get spoiled. 30 minutes is not a whole lot of time, and I usually don't say much in 30 minutes. So when I was asked to do this session on valuing young companies, my first reaction was, I really don't want to do this, because I know many of the people watching this session are expecting metrics or models or magic bullets that will allow them to value young companies. And unfortunately, I can't offer you those. Instead, I'm going to talk about what I think is the biggest challenge in valuing young companies. The challenge, of course, is dealing with uncertainty. When you think about uncertainty, as human beings, we go into denial. We push it away. We act like it's not there. Those unhealthy practices are what get in the way of valuing young companies. So what I'd like to talk about today are healthier ways of dealing with uncertainty. I'm going to start with a couple of big picture questions about uncertainty, and then move into 10 very simple rules you can adopt when you value young companies that allow you to cope with uncertainty. Let's first look at uncertainty. Uncertainty comes in many forms. It's part of life. In fact, when I look at a company and I think about all of the uncertainties we face when you value a company, I prefer to break the uncertainties down into groupings. The first grouping I think about is estimation uncertainty versus economic uncertainty. Let me explain the contrast. Economic uncertainty comes from the fact that there are things out there that we don't know what will happen. It's part of life. Estimation uncertainty is uncertainty you can reduce or even make go away by going out and collecting more information, building a better model. I'm going to give you some bad news. 90% of the uncertainty we face in valuation is economic uncertainty. No amount of homework or data is going to allow it to go away. Estimation uncertainty, you can deal with. The second grouping of uncertainty I think about is micro uncertainty versus macro uncertainty. Micro uncertainty is uncertainty you feel about the management of the company, what it does, its business model. Macro uncertainty is uncertainty about interest rates and inflation and what's happening perhaps in governments and politics, things that are out of your control. Why do we care? In much of valuation, at least with publicly traded companies, it's macro uncertainty that shows up in your discount rate, not micro uncertainty. And there's a third grouping of uncertainty that I think we need to think about. Some uncertainty is continuous. Take an example of a US company with operations in Europe. Every time the euro-dollar exchange rate moves, your cash flows are changing. That's continuous uncertainty. But some uncertainty is discrete. This is uncertainty that doesn't happen often, but when it happens, it could be catastrophic. Let's take the exchange rate example again. If you're a company operating in a country with fixed exchange rates, there's no uncertainty, right? As long as the exchange rates don't change. But here's the problem. One day you could have a devaluation of 75% and you get a complete breakdown of your business. In finance, we're very good with dealing with continuous uncertainty. But with discrete uncertainty, we're not that good. So I'd like to talk about uncertainty today in the context of a structure that you've seen me use before, which is the corporate life cycle. To think about why young companies are difficult to value, here's one way to think about how uncertainty evolves over the life cycle. If you think about the corporate life cycle, a young startup is like a baby. Then you have toddler companies. They fall, they get up, sometimes they don't get up. Then you become teenage companies. What do? They pose challenges for investors because they don't do things that put their potential at risk. Then you get to the peak of your life, and you get middle age, you get old, and then you go into decline, and there's corporate death. A morbid thought, but companies go through this life cycle, and the uncertainty you face changes depending on where your company is in the life cycle. When you have really young companies, much of the uncertainty you face is micro uncertainty, uncertainty about the company, its management, its business model. As companies evolve and become more mature companies, much of the uncertainty you face will become macro uncertainty. You're valuing ExxonMobil, you're not worried about the management of the company as much as you're worried about oil prices. And then you're going to decline, you start worrying about management decline because sometimes managers overreach when you're in a declining company. So not only does uncertainty shift as you go through the life cycle, the type of uncertainty you face also changes. In particular, the amount of uncertainty you face is greatest when you look at young companies. Why? Because everything is in flux. Now, as I said, One of the problems we face when we have uncertainty is we have unhealthy responses. Let's think about some of the responses people have to uncertainty. One is, of course, shutting down. There are some people who say there's too much uncertainty, I cannot deal with it. And guess what? A lot of people refuse to value young companies because they feel there's too much uncertainty. The second is denial. So what uncertainty? I don't see any uncertainty. The third is what I call mental accounting. You make up rules of thumb that you think work because it worked on some company at some point in time in the past. And then there's a fourth and very dangerous form of dealing with uncertainty, which is your outsourcing. When you feel uncertain, what do? You call in a consultant. When CNN wanted to start a streaming business and they couldn't figure out how many people would sign on, guess what they did? They called in McKinsey. And McKinsey did a really good job, right? When you think about uncertainty, outsource it. It's not as if the person you're outsourcing it has any special skills. You just don't take responsibility then for what goes wrong. So with that context, let's talk a little bit about what most people do with young companies. As I said, when people value young companies, the uncertainty scares them. You'd be surprised the number of VCs I talk to who look at valuation and say, you can't really value young companies. Why? There's too much uncertainty. So what do you do instead? I price companies. I price them based on number of users, number of downloads, number of subscribers. What I call the pricing imperative is always waiting behind the curtain. And when you feel really uncertain, what do? You stop valuing companies, you price them. What you're effectively doing is outsourcing again. You're outsourcing your uncertainty to the market and saying, the market must know better than I do what the uncertainty in this company is and dealing with it. So let's talk a little bit about valuation and how you can come up with coping mechanisms for dealing with uncertainty. The company I'm going to show you is not really a young company anymore, though it still behaves in some ways like a young company. On April 4th of 2022, Elon Musk made a bid for Twitter. And I was curious. I wanted to see what Twitter was worth, and I chose to value Twitter. I'm not going to dwell on this valuation because we don't have the time to go into the mechanics. But let me cut to the chase. The stock was trading at about 42. And if you remember, Musk's offer was 54. And I was curious about whether Twitter could be worth $54. So I took the company and I valued it with the status quo. When you value a company, you always take a point of view into the valuation. I told a story about Twitter where effectively it would find a way to monetize its large user base. This has been Twitter's potential right from its start. I actually valued Twitter at the time of its IPO, and I described it as a company with lots of users that hadn't figured out how to monetize those users. It's almost 10 years later, it's still the same story. That story animates my valuation. Every single number you see in this valuation reflects that story. What do I see? I see user growth starting to level off. When you've got 330 million users, some bots, but some regular users, over time, the user growth has to come down. Over time, I expect to see Twitter able to generate profits from these users. And as a result of that story and those assumptions, the value that I get for Twitter was about $45. At the time that I valued it, my suggestion was, hey, if you're paying $54, you need to change something about the company. Now, we're not quite clear what Musk's plans are for the company. There's talk of a subscription model. I'm not sure that'll work. But potentially, there is value from changing the company. The problem is the incumbent management cannot make the argument that change is why the company is worth more, because they've been running the company for the last decade and they've been unable to create that change. What I'd like to do, though, is take this valuation and list out 10 suggestions on how you can deal with uncertainty in more healthy ways when valuing young companies. I'm going to go through them one by one, but in a sense, you see the entire list of 10, but let me start with the first suggestion. I'm a great believer that we've become too dependent on Excel spreadsheets in valuing companies. Everybody is a financial modeler, and I believe we've lost the script. A good valuation is a marriage between stories and numbers. It's something I've always believed, and it's one of the books I've written. In 2017, I wrote a book on narrative and numbers, talking about the connection between stories and numbers. When I talk about evaluation being a bridge between stories and numbers, here's what I mean. When you show me the valuation of a company, every number in your valuation has to have a story that's attached to it. And every story you tell me about a company has to have a number attached to it. I believe this is true for all companies, but it's particularly true for young companies. And let's see why. When you have a mature company, you can afford to be lazy. You can take past numbers and project them out. You can do financial modeling. So if you're valuing Coca-Cola, Kraft Heinz, running a financial model is going to give you a pretty decent valuation. You try that with Palantir or Zomato or any young company. Here's what you're going to get: junk. You take last year's numbers and project them out, you're essentially going to get numbers that mean nothing. With young companies, you need to focus on the story first. Your valuation is a function of your story. Now, your response might be, how do I know my story is right? You don't. Nobody does. But your valuation is to be driven by a story you tell about the company. And as you age, of course, the importance of numbers matter. The way I describe it is, when you value a young company, it's like coming into chapter 2 of a 35 chapter book, and you can finish the rest of the book. You can put in new characters because you're in chapter 2. But when you're valuing a mature company, it's like being in chapter 32 of a 35 chapter book. The story's been pretty much told. The characters are set. You cannot create new twists and turns for this company. So that's my first suggestion. Rather than think of valuation as Excel spreadsheets and modeling, start with a story for a company, convert to numbers. Second stop, keep your valuations parsimonious. Less is more. I know the instinct that a lot of people have when valuing companies to add more detail, and we now have the tools to do it. We're drowning in detail. I see valuations that often run to 300 line items and 15 worksheets. Let it go. When you value a company, especially a young company, you need to focus on a few key variables. In fact, almost every company I value, I can basically boil down the valuation to 6 inputs. The first 3 relate to your business model, and I would argue that any type of business model is to be captured with these 3 inputs. The first is revenue growth. It captures the growth part of your business model. The second is a target operating margin. That captures the profitability of your business model. And the third is a sales to invested capital ratio that captures how efficiently you can deliver growth. You give me a company, I will boil it down to those 3 basics. And with young companies, it'll make your search much simpler if you keep it focused on the 3 metrics. The other 3 metrics are related to risk. 2 relate to your costs. One is, what does it cost you to raise equity? And the second is, how much does it cost you to raise debt? That goes into your cost of funding. But here's something we tend to forget when we do discounted cash flow valuation. Every discounted cash flow valuation is a valuation of your company as a going concern. You're saying, so what? Well, there's a chance your company might not make it, especially for young companies. And for those companies, you have to explicitly factor in the chance a company will not make it. Keep things simple, and you'll find your valuations become more in control. Now, as you go through your valuation, though, you got to make sure you preserve internal consistency. What do I mean by that? You're telling me a story about your company, a story of growth and profitability and reinvestment. And guess what? That story has to be consistent with itself. I tell people that the thing you have to worry about most is not other people disagreeing with you, but you disagreeing with yourself. Let me explain. Let's say you value a young company. I look at your growth rate and I see a high growth rate. It's your story. It's your growth rate. I'm not going to push back on that. You're entitled to your story. Next, I'm going to look at how much you're reinvesting back, and you can slice this and dice this as much as you want into capex and depreciation and acquisitions and R&D, but ultimately it's what you're setting aside for future growth. And guess what? If you have high growth, I expect to see high reinvestment. And the third component that goes in here is risk. And generally, we have high growth and high reinvestment. I expect to see high risk. I expect to see a cost of capital, if that's what you're using to capture risk, higher than the cost of capital of a typical company. High growth, high reinvestment, high risk. Makes sense. But if I see a valuation with high growth, low reinvestment, low risk, it's not implausible or impossible. I'm going to push back. I need to know why. If you have a really solid explanation, I'm going to let it go. But one of the things you can use to internally check your own valuations is to see if your growth assumptions, your reinvestment assumptions, and your risk assumptions hang together. Now, as you go along, though, there's a tendency that we have in valuation to ignore economic first principles. I'll tell you the number where you see this happen most often. It's that elephant in the room that we refuse to talk about in more detail, but we should, which is the terminal value. The terminal value, of course, is going to be 70, 80, 85% of your value. And you'll see people making up rules about terminal value that make absolutely no sense. Now, one of the things you cannot do when you're valuing a young company is to estimate the terminal value with a multiple of revenues, a multiple of EBITDA, a multiple of earnings. If you do that, you've taken the biggest number in your valuation and made it into a pricing, which leaves you with one of two options. One is to do a liquidation value, which really doesn't make sense for a young company. And the other, of course, is to use that stable growth model that terrifies people. Why does it terrify you? Because to begin with, you got to make an assumption that that growth rate can last forever. Forever is a scary word, but it comes with constraints. If you're telling me your company can grow at a constant rate forever, that growth rate cannot exceed the growth rate of the economy. This is not a question of your assumptions versus mine. It's pure math. A company cannot grow at a rate faster than the economy forever. So you assume that the growth rate is less than that of the economy. You got to reinvest enough to sustain that growth. This notion that you can have a stable growth rate without reinvestment is not just dangerous, but delusional. You got to give your company the characteristics of a mature company. And you got to ignore these stupid rules of thumb, like your terminal value shouldn't be more than 75% of your intrinsic value. Guess what? When you buy a young growth company, your terminal value can be more than 100% of your value today, because you got to live through stages of dilution to get to that nirvana, which is terminal value. Borrow on economic first principles and it'll make your life a lot simpler. Now, along the way, there are some macro numbers you'll be forced to estimate. Things like risk-free rates, equity risk premiums. You have enough on your plate already, and you shouldn't be spending hours or days trying to figure out what the risk-free rate and the risk premium are. Outsourcing. These are numbers you should be outsourcing to the market. At the start of every month, some of you might be aware, I compute an implied equity risk premium. This is not an equity risk premium that I'm getting by looking at the past. This is not my judgment or my estimate. I'm backing out from, based on how the market is priced, what the number is that the market is putting in as a price of risk. That's what an equity risk premium should be. That number at the start of this month, at the start of May, was about 5.2%. At the start of this year, that number was 4.2%. Over the course of the last 4.5 months, the price of risk has gone up 1%. Why? Well, look at the macro environment around you and you can see the answer to it. So rather than slicing and dicing historical data and making your own judgments on these numbers, let the market tell you what it is. Along the way, though, there are numbers that you shouldn't be spending too much time on. And I'm going to surprise you with one. If you look at the term discounted cash flow valuation, obviously discount rates are a key part of what you need to estimate the value of a company. That said, though, I think we spend far too much time estimating discount rates and too little time talking about cash flows. So I'll make a suggestion. You're valuing young companies, spend less time on discount rates. Don't spend time estimating the beta and the debt ratio and the cost of debt for a small company or a young company. You're saying, how do I estimate a cost of capital? At the start of every year, I create a histogram, basic statistics of the cost of capital of every publicly traded company in the world, 46,000 companies. Basically, I look at the median, and I get a distribution. Guess what I do when I value a young company? Rather than estimate the cost of capital for that company from scratch, I go to the 90th percentile. You think that's pretty sloppy? I'll accept being sloppy on the discount rate if you spend that time on cash flows. Less is more. At the start of this year, the cost of capital for a median company was about 6 to 7% in US dollar terms. Of course, if we have a higher inflation currency, add the differential inflation rate, 6 to 7%. The 90th percentile was about 10%. The 10th percentile was about 4.5%. Think about that. 80% of global companies have cost of capital between 4.5% and 10%. And we're wasting our time trying to estimate that number to the second decimal point. Now, with young companies, one of the things that should concern you is the fact that your company will not make it, the failure risk. You know what VCs try to do, right? They take this failure risk and try to squeeze it into the discount rate. Don't go there. Discount rates are blunt instruments. They were never intended to bring in failure risk. So when you see discount rates of 30, 40, 50%, somebody's playing games with you. You're saying, there is failure risk. What do I do about it? Estimate it. Think about decision trees and statistics. Think of your discounted cash flow valuations, the value of your company as a going concern. Say there's a 70% chance of that. Think about what happens if you fail. With many young companies, if you fail, guess what your equity is worth? Nothing. Your expected value would be 70% times your discounted cash flow value plus 30% times zero. Well, effectively, what you're doing is you're dealing with failure risk separately. I think that's a much healthier way of dealing with failure risk than squeezing it into your discount rate and trying to make it into a number that it cannot be. Now, one of the things I said at the start of this session is uncertainty is part of life. Instead of going into denial, face up to it. What does that mean? I don't know whether any of you have ever done a Monte Carlo simulation, but let's step back. When we do discounted cash flow valuations, we make point estimates of revenue growth, point estimates of margins, point estimates of reinvestment. And as we're doing this, we're almost screaming, saying, I don't want to do this. There's a lot of uncertainty about these numbers. You're right. But 40 years ago, what choice did you have? Today, we have choices. When you feel uncertain about a number, rather than making a point estimate, why not give me a distribution? Instead of telling me the margin is going to be 15%, why not tell me the margin can be anywhere from 11 to 19%, and this is the distribution I expect? If you can give me distributions for the inputs, a simulation follows right out of the distributions. With the Twitter valuation you saw, I had a point estimate of about $45 per share, but that's a point estimate. Am I sure about it? Are you kidding me? How can I be sure about something where so many things can change? I did a Monte Carlo simulation and it helps me. It gives me a distribution of value. Remember the $54 that Elon is offering? That's around the 75th percentile. Could it get there? Absolutely. But by having a distribution of value, you recognize that uncertainty is part of life. Your value is therefore not a precise value, but a reflection of the uncertainties you face in each of the inputs you compute. Now, as you're making these estimates of the inputs, as I said, part of you is screaming, but I could be wrong. I could be wrong. Let me save you the trouble. You're definitely wrong. In fact, you're going to be wrong 100% of the time. And guess why? You're not God. When you're trying to estimate inputs for a young company, every single input you're going to get is wrong. Now, if your reaction to that is, I don't want to be wrong, don't value companies. Here's your consolation prize. You don't have to be right to make money. You just have to be less wrong than everybody else. And guess what? My odds of doing that are greater with young companies than with mature companies. I remember at the start of 2019, there's 1 week where 2 stocks went public in the same week, both names that you'll recognize. One was Lyft, the first ride-sharing company to go public. It preceded Uber. And the other was Levi Strauss. If I asked you which of these 2 companies can you value more precisely, the answer is obvious. It's Levi Strauss. It's got an established business model. You know exactly how it makes money. But if you ask me which of these 2 companies is there a greater payoff to actually valuing the company, my answer is going to be Lyft. Because guess what? Anybody can value Levi Strauss. You give me a 10-year-old with a decent amount of intelligence, I can probably teach him enough valuation to value Levi Strauss. It's in valuing Lyft that your challenges will rise, and it's in those companies where if you can value companies, the payoff is going to be greatest. One final point. I think we dance this dance of being objective when we value companies. And I think that's a dangerous one. We have to recognize that when we value companies, we bring in bias. Why? Because we have preconceptions and priors about companies that find their way into the valuation. I think we have to be aware of those biases and be open about those biases. If you like a company, be clear about it before you sit down to value a company. In fact, I do a session called the Bermuda Triangle of Valuation about the 3 biggest challenges in valuation. And none of them have to do with betas and cash flows and discount rates. Here are the 3 biggest enemies of valuation. One we've talked about, uncertainty and how we deal with it. The second is complexity. Complexity is part of the process, but we build in more and more complexity. And after a while, we lose control of the process. And the third is bias. There's nothing you can do about bias, but you can put down bias as you sit down to value companies. Am I biased in my valuation of Twitter? Absolutely. I don't much like the company. I don't like the way it's managed. And you should know that when you see my valuation. Am I biased when I value Apple? Absolutely. I love the company. And you need to know that when you see my valuation of the company. Sometimes we fall in love with our own stories for companies. And when you fall in love with the story for your company, you're in real danger. In my book on narrative and numbers, I talk about keeping the feedback loop open. What that means is when you value companies, you tend to show to people who think just like you. A bunch of CFAs hanging out together, guess what? You show your valuation to each other, you pat yourself on the back and say, that's amazing. My advice to you is hang out with people who don't think like you, who haven't learned the same script. And don't get defensive when they point to things in your valuation. I don't understand that, because that's how you make your valuations better. With young companies, I recognize there are people out there who know a lot more about these companies than I ever will. And I need to listen to those people when I want to think about valuing my companies. I'll close with a lesson I learned when I first valued Uber in 2013. A young company, barely any financials. I told a story and I valued the company. And I got the story wrong. Bill Gurley, lead venture capitalist at Benchmark Capital, one of the lead investors, one of the first people who invested in Uber, pointed out the mistakes in my story. And I'm glad I listened, because it made my story better. So remember, valuation, especially with young companies, but telling a story, connecting the story to numbers, and then learning to recognize when you got the story wrong and correcting that story. I hope you have fun valuing young companies, because I sure do. I'd rather value young companies than mature companies, but it comes from being willing to be wrong and to be willing to correct the mistakes you made in your stories. In a minute or so, I'll be taking your questions, and I'd be glad to hear any questions about anything to do with valuation, even if it's got nothing to do with young companies.
Well, that was a fascinating discussion. I think you'll agree. We've now got a chance to have a bit of an in-depth discussion with Aswath. I know you've had a lot of questions and comments coming. I'm going to be keeping an eye on those. First of all, I'm going to give my own questions to Aswath. We're going to chat for around 20 minutes or so, and then I'm going to turn it over to you, the audience. I want to encourage you now. Do submit your questions. You've got that tab function in the top right-hand corner of your screen. The team here are going to see all those, and then I will pose them to Aswath. But now it's great to see you in person, Aswath. We've spoken on air a number of times on CNBC. I've only ever seen you virtually, so it's good to have you in the flesh today. Fantastic stuff there about valuing young businesses. I want to pick up on a few points, and just starting at the end, you were talking there about, if I can call it this, the danger of falling in love with the narrative of a company. Now, a lot of this has to do with bias, something some of our other speakers are going to be talking about as well. Talk to us a little bit about how young valuers, or valuers of young companies rather, can break out of their biased thinking.
As I said, we're in a world where we tend to hang out with people who think just like us. It's the nature of specialization. And I think it's too bad. I think we need to talk to people who think less like us. And I'll give you an example. When I valued Airbnb, and this was when they went public, the first person I talked to was actually a friend of mine who rents Airbnbs in San Diego, knows nothing about finance, knows nothing about investing. Because I wanted to hear what her reactions were to the story I was telling about Airbnb. And I learned a great deal about their business model by talking to them. With Uber, I've learned more about Uber by talking to Uber drivers than I would ever learn by talking to Uber management. Sometimes it's just listening to people that you don't think know much about finance, but know a great deal about the businesses you're valuing, and understanding what it is that makes that business tick, and being open to the fact that you might have gotten the story wrong as you listen to those stories.
So that's very much in the narrative, the emotional, the anecdotal quadrant that you presented there. And you talked about there being a marriage between narrative and numbers. Is there a sort of balance? What does that balance look like? Exactly 50-50?
For younger companies, it's more like 80-20. It's mostly stories driving your numbers, because the story changes, your numbers are going to shift. I mean, that's why young companies make a big deal about total addressable markets. They make that their selling point. As an example, Uber went public, they claimed their total addressable market was 5.2 trillion. Completely delusional, because they counted everything that everybody spent on anything transportation related as a total addressable market. But they knew if they held that 5.2 trillion up there, investors would look at it and be so dazzled by that number that they wouldn't flesh out the rest of the story. So some of this is recognizing that companies want you to just think story and not numbers. I mean, the VCs and founders know this game very well. And recognizing as investors, you can listen to big stories, but you still have to start to think about how do you convert those stories into actual numbers. So the young companies, the story is driving the valuation, and changing the story is going to make a big impact on your valuation.
And what you're saying there, applies to a major company like Uber, but you need to have noticed those signs early on in its story. But you're really making me think of what's happening with Musk and Twitter at the moment. Musk basically stalling this deal because he says there's too many spam bots, too many fake accounts on the site, which some have alleged it almost, I'm not saying this myself, but some have said it almost amounts to a sort of fraud on the part of Twitter, an SEC filing showing they have X many account users, and Musk pulling back and saying, no, I don't believe that. There's X many spam accounts. Advertisers obviously pay Twitter for access to the platform based on the users they've got. In that sense, do you think Musk is sort of giving us all a valuation lesson at the moment?
I think so, especially user-based companies. We've fallen in love with the number of users. I'll give you an example that's different from Uber. Take Netflix. For 12 years now, Netflix's price has been pushed up by one number and one number alone. The number of subscribers they seem to add on year after year. They failed in the most recent year, but that's been their selling point. But I've never seen analysts ask, where are those subscribers coming from? And the reason that matters is in the last 2 or 3 years, much of the subscriber growth for Netflix has happened outside the US. The US is saturated. And a big chunk of it is coming from India. And the reason that makes a difference is an Indian subscriber pays about 1/6 what a US subscriber pays. An Indian subscriber is worth about 1/6 what a US subscriber. So I'm not saying the number of subscribers don't matter, but we're not asking enough questions about users and subscribers. And maybe we've got, I call these bar mitzvah moments with company where suddenly you wake up and you say, well, I've been fooled by the number of users, but I want to know more. And I think we're having that wake-up moment. I think Musk's reasons for introducing this might be different. Maybe he's trying to negotiate a lower price, but he's raising a very important point about users, that not all users are created equal, especially when you're using that as your marketing pitch to investors. Look at how many users we have.
And let's go a little bit smaller down the scale. No less successful, the pandemic darlings. You've mentioned quite a few of them already. Anecdotally, it was people thinking, well, I'm logging into Zoom, so that's a good investment. I'm ordering from Deliveroo, that's a good investment. So it was anecdotal, driven a lot through the pandemic, but it's quickly sifted out which ones have survived and which haven't. We've seen a big sell-off in some of these pandemic stocks.
I think this is the danger with trend-driven investing, which is you pick up a big trend, you assume that everything in that trend is going to be a good investment. If you look at Cathie Wood and ARK, you built an entire business model around, hey, I can spot trends and I'll pick companies in that trend. The problem is that you're taking just the first part of the story, you're not fleshing out the rest of the story. Take the electric car market. We can all agree that this is going to be a really big market. We can disagree about how big it's going to be, but that doesn't mean every electric car company is going to be a beneficiary of the market. Now, I call this the big market delusion, where you let the big market drive up the prices of every company in that big market, not recognize the market's not big enough to sustain all of them. So I think that's what happened during the pandemic is people looked at the pandemic, they extrapolated based on the pandemic for Zoom and Peloton and all of the other players. And now they're recognizing first that things didn't shift as much as they thought they did. And these might not be the only players if the market turns out to be as big as it turns out to be. So that's why it's important not just to tell the story, but to flesh out the details, because that makes you think about, hey, I've got the trend right, but how do I know I've got the right company to take advantage of this trend?
You mentioned Cathie Wood there, a name that always generates headlines from a journalistic perspective. And obviously we've seen the performance of the ARK Innovation Fund, of course, but interesting just to think about it in the broad concept of these mega cap tech stocks and FANG stocks as well, and what's happened in recent weeks. Because actually we did a survey at CNBC recently of 53 tech-related companies that have been tracked by CNBC that IPO'd in 2021 or did a direct listing. All but 3 of those 53 are now trading below their offer or opening price. So in terms of that herd mentality, is that just what went on?
I think for a decade, risk capital was free and easy. I mean, and when I talk risk capital, I'm talking everything from venture capitalists to public market investors investing in young tech companies. In other words, they bought the story, but people are not asking the questions about does that story play out in numbers? That's lazy investing, and lazy investing eventually blows up. But this is not new. This has happened through the history of markets. And you know what? I think it's actually part of markets. I don't think of it as a good thing or a bad thing. It is part of what we are. In fact, I tell people, look, do you want to live in a world run by actuaries? Because we'd still be in caves. I mean, the nature of human beings is we overreach. We overreach as companies, we overreach as investors. There's a correction that happens, but in the process, we change the way we live. The dot-com bubble might have burst, but it changed the way we live. This too shall pass. It'll change the way we live, but there'll be a price adjustment as people's expectations come back to earth.
And I kind of want to get back to the psychology bit after going through some of the number stuff, but I just want to ask you this idea of this too shall pass. It came up to me this in mind when you were talking about the confidence of just being able to let it go, having hundreds of line items whilst valuing a company. Some of our viewers will be new entrants into the finance profession. Some watching are very, very experienced professionals, but what advice can you give them about building that level of confidence to just let it go?
For some people, it'll never come. I'll be quite honest. There are some people who are not psychologically designed to value companies because uncertainty terrifies them. They're so afraid of being wrong. They so want precision that this is not the profession for them. It might be too late for me to tell them that. But if you lie awake at night thinking you got the second decimal point in your cost of capital wrong, maybe this is not what you want to do for a living. I mean, I call this the karmic point in investing, where you got to say, look, I've done everything I can. I'm letting go because the rest is out of my control. And in valuation investing, you got to recognize when you hit that karmic point, because if you don't, you're going to drive yourself crazy trying to be right.
Do you say that to your students on the first day of term?
Absolutely. Absolutely. It's the first piece of advice. I tell them, look, don't fight it. For some of you, the recognition will be this is not what you want to do. And you know what? We live in a world with index funds and ETFs. You don't have to value companies to buy them. It's a healthy recognition that this is not what you need to do. Of course, if this is your living, you're an appraiser or an analyst and you need precision, I think you've created a lifetime of ulcers for yourself because you're going to be worrying about things that you really can't control.
Time to invest in Pepto-Bismol. Now, let's go back to the process. You've talked about this misconception of the sort of link between value and price. They need to be kept separate. In your time in the finance industry, observing it, studying it, being in it, do you think we've reached a point of being better at that?
No, it ebbs and flows. It ebbs and flows. It's the nature of markets. There'll be times when people say, well, value has to be close to price. And so you can argue that 2022 is an adjustment process because the price process went a little bit out of control, especially during COVID. There's an adjustment process. Will we learn from it? No, human beings never learn. 5 years from now, we'll be back to another bubble of some sort in a different sector. We just keep moving because it's the nature of it. We're capable of incredible amounts of amnesia, forgetting our past mistakes and repeating them over and over again.
In that sense, then, how do you think the pandemic, which is still very much fresh in a lot of our viewers' mind, we've got viewers from all over the world, some people are maybe even watching this from a lockdown in Shanghai or in Beijing, but for a lot of us, it's very fresh in our memory. How do you think that changed psychology towards valuing companies?
I think we've got to let it go. I think there's too much of the pandemic in every story that I see. There's too much of the pandemic being used as an excuse for everything that goes wrong. So at some point in time, we've got to say we've learned our lessons, but we've got to kind of get ready for a world post-pandemic. I don't think people, I asked every person in my class to value a company, and in almost every company, the COVID became a big part of the story. And I think it became too big a part of every company's story, and I think we've got to kind of back away from that and think about what will Boeing look like post-pandemic. Maybe we need to start thinking about the Dreamliner more and less about COVID and valuing Boeing. It's going to be tough to let go.
And I hear that argument, but at the same time, Airbus absolutely pulling out ahead of Boeing at the moment in terms of orders, in terms of the way it's functioning. And some might argue that it was the pandemic and the speed at which they were able to come out and complete those orders and get that order book filled quicker.
In fact, I think you're making my case, because the reason Boeing was able to do that was it went into the pandemic with the 737 MAX issues and the Dreamliner issues. And because of that, it's been handicapped coming out. So the problems that Boeing has, Boeing will blame it on COVID and the pandemic. But the reality is, Boeing should blame itself. It's created many of the problems that it's now living with. And the reason Airbus is ahead of Boeing is precisely because of those micro components of the companies that essentially worked against Boeing.
There's just so much we want to cover. I'm keeping a close eye on the time. But in terms of the other themes of the conference, the summit that we're having in the next few days, we're talking a little bit about AI and these kind of technologies. Some might call them disruptive. We're probably already past that point in terms of the investment profession. Do you think machines versus humans, you know, it's oversimplified, yes, it's been asked before, but do you think humans have some sort of edge?
I think that, you know, from a valuation perspective, I can think of things we can let machines do for us. In fact, I tell people who are appraisers, if 95% of the things you do are mechanical, a machine can do it better than you can. We're begging to be outsourced. But that's where I think the storytelling part and recognizing that history is not always a good guide for the future will mean that you've made yourself more critical to the process. That said, though, I think that people have this false hope that machines and artificial intelligence is somehow going to rescue us. You know, the reality is active investors, who are the ones who are looking there, think that this is going to rescue them from this decade of losing out to index funds and ETFs. But my response to that is something I say in my class all the time. If everybody has it, nobody has it. If everybody has machines, guess what? It's a mutually assured destruction. We all spend more money on machines and we make the same returns we did before. And I'm afraid that's where we're going to end up with AI and machine and any kind of machines we bring into the process. We're all going to be spending a lot more on those things, but we're not going to be making higher returns as a consequence.
And it all absolutely feeds into that discomfort issue that you like talking about so much. Now, we do have a lot of questions coming in, so we do actually want to get to these to give you the opportunity to pose your thoughts to Aswath. If we have time, we'll get to all of them. Please do continue to submit them, but we've got a few to start us off here, Aswath. This first one being, what is your take on companies who are cash flow negative for years, but fetch valuations in the billions?
You're talking Amazon? Because Amazon is, in fact, if you're thinking about a prototype for how you build a successful company, Amazon would be a company that had negative cash flows through its first 18 or 20 years and still managed to deliver these huge market caps. The reason, though, is Amazon told a consistent story right from the beginning. I mean, you got to give the company credit. I call them my field of dreams story for a long time, which is they said, if we build it, they will come. Build rev. And they acted consistently. Not every negative cash flow company is able to pull off an Amazon. In fact, I would argue that Amazon is one of a kind. Salesforce is an Amazon wannabe, but it's probably the closest Amazon wannabe you're going to get. So not every company with negative cash flows ends up with large market cap. I think we have a selection bias here, which you tend to see the most successful of these companies, and we miss all those companies that crash and burn with negative cash flows that don't make it. So rather than view it as some kind of delusion, people are just missing the pricing, I would say look past the negative cash flows at why these companies are able to get the market capitalizations they do. And the answer often is because they have a management team that is telling a story that is consistent with how they act. And that's really difficult to do.
Wonder what role Rivian will end up playing in that. But I want to move on to the next question here from the audience, asking that if narrative drives inputs to valuation, then improving the company's story is a value-add activity, which can increase growth. Is that sort of what you're talking about there? It's this improving the narrative will also, I think this is what this person asking, add that sort of, it adds to the value?
I think that's what I think a CEO's job is. It's not to manage the inventory. It's not to reduce working capital needs. It's to tell a story about the company they're heading. And to me, that is the key role of a CEO or the top management, is framing the story. And that story has to be both credible and plausible. So you can't tell a story that just sounds good and not be able to deliver. You got to think about what you can deliver on while you tell the story. I give the contrast between Uber and Lyft. I think Uber's tried to tell too big a story. That's been actually their biggest weakness. They want to be everything to everybody. In contrast, Lyft has a much more focused story that they can deliver on. So as a CEO, you got to walk this fine line between telling too big a story and too small a story. But that's really your only job. What else do you have to do as a CEO?
Is this true? This is true, but probably also provide the numbers and the correct filings to back
in a
it
sense,
up.
that's what the rest of, I mean, in a sense, if you tell the right story, you're reflecting what the organization you head is able to deliver. Because if you're telling a story that you can't deliver on, you're going to not be able to meet the numbers that people expect to see coming out of that story.
And without wanting to make it political, but that's often what people say about some of the best leaders out there. They are leading on communications as a front piece. Now, another question on valuation here from the audience asking, what place do real options play in the valuation of startups?
You know what? Real options have become a buzzword that people use to explain away the difference between the value of something and the price they want to pay for it. Now, I first wrote about real options in 1992. So I was in this game well before everybody else leaped in. So but I view it as a skeptic. I think that the real options argument can be used for some companies, but the key word to think about is exclusivity. In fact, the paper I wrote on real options is titled "Opportunities Are Not Options," because that's what I see people using the argument for, is whenever they say big opportunities, they use the word real options, but that's a misuse. You need exclusivity. You need to be able to show me that you and only you can take advantage of this opportunity. I'll give you places where the real options argument has some resonance. A platform company. And let's face it, a lot of user-based companies have platforms. Is there a real options value to Facebook? Absolutely. Why? Because there are almost 3 billion people on your platform spending an hour every day. Right now, you're just making money through advertising. But to the extent that you can monetize their spending time in your platform, there is a potential added value. So companies that have a platform of very loyal users, intense users, you can make the real options argument. But for platforms where users are transient, I'm not sure you can make a real I don't think I could make a real options argument for an Uber user platform because people come and go. There's no stickiness. But maybe with Facebook, maybe even with Twitter, and maybe that's the real reason Musk wants Twitter, is there is a platform value to having a couple of 100 million users who are in a sense addicted to your platform and want to come back to it over and over again.
And, I'll attest to that. I'm pretty addicted. I know you've got a profile and you don't actually tweet that often, but when you do, it's always high value. I do like this next question, and that was a very generous answer. So I hope that answered that question from our audience. This one's very interesting because we haven't really talked yet about the different kinds of markets, the different regions, 146 countries and regions tuning in here. This question: for frontier and emerging markets with nascent databases, what do you turn to get a sense of the risk premium?
First, nascent databases don't matter with young companies because you're not as dependent on data. The problem with emerging markets is there's always a macro component to your story, which is, let's say you pick an Indian company, an Indonesian company, a Nigerian company. You tell a story about the company. Lurking in the background or in the story is what happens to the country, the government, because you can take a great story and bring it crashing down to earth if the country you're in comes crashing down to earth. 2 years ago, I valued the Tencent, Alibaba, Didi, the big Chinese tech companies. And I said, you can't really tell a story about these companies without bringing Beijing into the story because the government is part of the story. Mm-hmm. And unfortunately, with young companies in emerging markets, that becomes part of the story. And the reason I say unfortunately is this is part of the karmic point of valuation. You really cannot control that part of the process, but it could bring your valuation down. So I think the data part doesn't bother me as much. The question was about risk premium, though. As I said, risk premium should be not even on your top 10 lists of worries when you're thinking about valuing young companies, because that goes into your discount rates. I have this very mechanical way of estimating equity risk premiums by country. I go back to it, I use it, and I move on, because I don't want to spend 80% of my time estimating the risk premium for Nigeria if I'm trying to value a Nigerian company. So country risk is always there. Try to bring it into the discount rate, then let it go. There's not much more you can do about it.
Let it go again. And I just want to pick up on that point. You can't ignore the politics sometimes when it comes to exactly valuing a Tencent or an Alibaba in China. But a lot of that, assessing the risk premium you were talking about, you've got to assess what's going on. Tech regulation coming directly from the Chinese government. A lot of that comes from the quality of information that an analyst is consuming. So just as a follow-up question myself, where would it would be good for our viewers to be looking for that kind of information to make those risk assessments independently?
Now, let it go doesn't mean ignoring it, right? So if you're in a country where there's a big chance of nationalization, let it go means estimating a likelihood you'll be nationalized, bringing into your value. Now, with Chinese companies, let it go means bringing in the effect of the government into your growth and margin assumptions. So when I valued Alibaba and Tencent, I brought down both my growth and margin numbers for those two companies relative to valuations in earlier periods where the government was an ally, not an enemy. So letting it go means incorporating what you can do right now. And that might require, again, going beyond finance, going beyond numerical data, because this is now the realm of politics. You're talking about, hey, what form will those regulations take? You're getting some advanced views of that by looking at what the EU is doing, right? In terms of regulation, you can see the impact it has on companies. My guess is that it's going to make the biggest companies more powerful. It's going to have a perverse impact because all of these rules that are designed to bring Facebook and Google into line are also going to be rules that small startups have to play with. When Google and Facebook have the resources to do it. So in a strange way, governments trying to bring these companies back into line might actually make them more powerful players going forward.
A one-size-fits-all approach. Complicated. Now, this one's a good question, given the idea that you had that COVID factors too heavily in sometimes in the narrative part of valuation. Climate risk. This person says it's been a big issue for many companies and one of the most uncertain. How would the effects of climate change affect valuation models?
Well, to the extent that you have a company right in the heart of climate change, a fossil fuel company, an automobile company, it is at the center of your story. Let's face it, you can't value GM and Ford without having a point of view about climate change and how it plays out. But if you're worrying about climate change when you're valuing Apple or Google, you've lost the script. And that's my problem with climate change. Use it in the companies where it matters. Stop talking about it in companies where it's not an issue. And my problem is the way disclosure is going, you're going to be spending 200 pages in Apple reading about their climate change effects when nobody really cares. So for those companies where it's at the center of the story, bring it in. For the other companies, let it go. It's really, again, the let it go part comes in, which is if you try to bring that into the valuation of a company where it doesn't matter, you're spending time on something that doesn't have a central role in that story.
Fascinating stuff. This final question from the audience for the moment as well. We mentioned Cathie Wood, always a divisive figure. And, you know, here at the summit, we're not advocating for or scrapping any type of product or fund. Absolutely not. But this person wants to get your view, Professor. What's your brief assessment of ARK Fund's valuation of young companies?
They don't value companies. That's the problem. They price them. They price them based on macro trends. I mean, I'll be quite honest. I admire Cathie's capacity to call major trends. I think she's really good at it. And I think the problem is the company selection that goes with it, those trends don't have the kind of homework you need that really give you good investments. So I think that when you have a trend-driven investment strategy, you also need enough homework that tells you that you're picking the right companies given that trend. You can't just tell me, buy this company because it's going to be part of a really big trend. So I think Cathie's weakness is at the company selection level. Her strength is at calling the trends. I think she's really good on macro trends. So I think there's a way back for her if she's willing to think about how do I bring in more company-specific storytelling into my investing. And if she can do that, then I think she can take advantage of a trend capacity to call trends.
Now, a bit cheeky this, but I do want to just get your view before we wrap up. It's not necessarily about valuation of young companies, but I know you've often had a lot to say about Bitcoin. The first speaker we had today, Tyrone Ross, was talking about the benefits, as he sees them, of Bitcoin, the democratization of access for the underbanked, for example. We've seen Bitcoin drop heavily in the recent weeks below that $30,000 level. In terms of valuing it as an asset, as an idea, where do you stand currently?
Well, I've always had an open mind on Bitcoin, which is, tell me what it is. Initially, I was told it was a currency, but it's a currency that nobody seems to use on transactions. Then I was told it's a collectible. and it doesn't seem to behave like a collectible. Collectibles hold their value when financial assets are collapsing. So if it's not a currency and it's not a collectible, I'm not sure what it is. And if I'm not sure what it is, what the heck are we doing paying $30,000 for a currency that nobody uses and a collectible that doesn't behave like a collectible? So my problems with Bitcoin are at the transaction level. I think the problem with people pushing for Bitcoin is it seems to be all driven by look at how much money you can make on Bitcoin. Name me one currency where the selling point for the currency has been look at how much money I made speculating on the currency. To me, that's a bad sign when that becomes your key selling point. I describe Bitcoin as a currency created by the paranoid for the paranoid. And the reason I use those words is because it's built on a complete absence of trust. You don't trust institutions. The problem is that absence of trust means it's a very inefficient currency and it'll stay an inefficient currency. And as long as that's true, I'm not sure that I can find the reason to put money into Bitcoin because I can't think of a good one right now.
And just I always say this, just one more, but that idea of trust in Bitcoin when it comes to a company like, for example, Tesla, is it all still about that trust level?
It is, right?
Yeah.
Especially with young companies, because it's a big story. You need people to deliver the story. And that's why one of the reasons I felt when Musk made his bid for Twitter, I said, this is not a good idea because you got this really big story that you've sold the world with really well about Tesla. Do you want to put that story at risk on this side play? Because Twitter is a side play. You got $1 trillion company. What the heck are you doing distracting yourself with a $50 billion company that could actually get in the way of your big story? So when you're telling a really big story, get out of your own way. Don't start to introduce distractions. But with Tesla, that's actually never going to happen because the nature of that story is you're always going to have distractions.
It's a distracting kind of brand. It's one that's generated, again, a lot of headlines. Always interesting to talk about. Aswath Damodaran, always fantastic to talk to you. Thanks so much for your time today. We do appreciate it. And thank you all so much for your questions. Do stay with us here at the event. We're going to break now for just 30 minutes. When we come back, we have a fascinating discussion with Jeffrey Ubben. Following that, we'll be talking about thinking through inflection points with Rebecca Patterson. So much more to come. Don't go anywhere, but we will see you in 30 minutes' time.